Hello, everyone, and a very warm welcome to this week's Major Markets Update for Saturday, January the 4th, 2025. I appreciate your patience and waiting for this webcast, but I am sure you also appreciated the brief intraday update we sent out yesterday, showing that indeed the end, as we were looking for on January 2nd, was most likely in sight. And we showed you the reasons why in yesterday's email we believe the bottom is most likely in. So we're giving a bottom alert. It doesn't get much closer than that. If you can get the bottom alert pretty much 6 hours after it happened, that is as close as it gets, because the evidence really starts to support this is the case. We showed you several reasons yesterday using the S&P 500, and we're going over additional evidence that suggests that at least a tradable bounce is underway. So let's go straight to the charts and see what we have. I'm sorry here, press the wrong button. It happens. Again, we can never be 100% reliable, right? It's impossible. I just listened to a podcast where they said most experts have a fail rate of about 20%. Now, I hope that's not going to be your surgeon, because they should not have a fail rate of 20%. Top athletes, the highest paid people within their professions have an 80% reliability. So, since we're dealing with one of the most complex systems in the world from a predictability perspective, I think we're doing pretty darn well. Again, it is up to you to place your stop losses where you seem fit. We do provide our warning levels as, of course, a help to that. But in the end, you are responsible for your own trades, and please trade it well. Scale out, and you can also scale in. Always add to winners. Barely ever add to losers, I would say. Barely ever. You might want to break the rule once or twice a year, but boy, you can get schmacked, because the more downside you have to eat, the more it will take to fill back up. That is the unfortunate, may the odds always be against you, nature of the stock market. Again, many ways for you to get help. I am here to help. That's what you signed up for. As said, stock market is one of the most complicated things you can deal with. So we can need all the help we can get. I'm your personal trainer. I'm your manager. And I'm here to help you. If you want to step into the ring, fight Mike Tyson, at least wear some gloves, right? So straight to the charts. Over with the pleasantries, and we're going to start here with the S&P 500. This was our preferred wave count, an A, a B, and a C, bottomed where it had to, topped where it had to, and then it declined slightly to above where it had between parentheses, because the market doesn't owe us anything. All right, the market can do whatever it wants to do as long as it sticks to the Elliott wave rules with, for example, the third wave can never be the shortest wave and all that good stuff. Now I see that stock charts once again has changed the labels of the 176.4 and 1%. Don't ask me why. It is honestly a very clunky a charting software. I don't know why I kind of stick with it, but I have so many charts here. If I would transfer that, you will not get an update for the next 6 months, because that's how busy I would be transferring all the charts that I have. Of course, stock charts has a lot more information that a lot of other services don't provide, so I'll stick with it, but it is really annoying. Sorry, rant over. It is Saturday morning. I need to rant once in a while. Not your fault. These are just the technical difficulties we have to deal with. So most likely this wave 5 is underway, contingent on holding above Thursday's low. All right, so we looked at 57.37, 58.17, and I believe we got 58.29. It doesn't get much closer. And we explained yesterday why we probably have this little undershoot, because we had a slight overshoot. 60.70 would have been ideal. We got 60.99, I believe, so it was off by 30 points. So then you also probably see some undershoot here. You know, I know it's after the fact. You just don't know that before, but that's an explanation on why we did not fully go into this target zone. But otherwise, this looks still really nice. And of course, this is the trend channel, but you know, we can of course start to change it. For example, something like this. That's all fine. Trend lines are just there for you know, a secondary behavior of markets that stay within the trend lines. So we have the warning levels for the bears, so already broke above the first one, etc. Okay, so we can of course move the warning levels for the bulls accordingly, and the first warning level would be, because this is now a bullish wave count, the first warning level for the bull would be, of course, Friday's open. The second warning level would be, I would say, Thursday's close. The third warning level would be pretty much, of course, Thursday's low. And then that would be, or I'm going to put that right there. Sorry, not there. That would be the open here at the A wave, as you can see. And then, of course, the final would be, of course, Thursday's low. And Thursday's low is very equal to, of course, the A wave. And this is then all we got. We got a contracted, I guess, instead of protracted, a shortened C wave. C waves can do that. They don't have to be equal to A. They don't have to, okay? As long as we get into the target zone and the C wave can extend, so it can also be shorter, okay? It can do whatever it wants to do as long as we, of course, bottom and top, we pretty much have to. So these are the warning levels for the bulls. Massive positive divergence, as I showed you, on the RSI 5. That is often a very good sign that the low is in place. At the minimum for a bounce, right, that we have completed wave A. And then wave B and C. I've showed you those options in Friday's update, so I'm not going to repeat them here. And for those who watch YouTube, and that is the unfortunate nature that you're going to miss out on those options. This is the weekly chart. And as you can see, also here, we were anticipating a 4 and a 5, a bit higher into the 6,240s. So this matches still really well. We have continuous negative divergence, not so much on the MACD, but definitely here on the RSI 14 and some of the money flow indicators. So this one matches our wave count still very well. So then we have the wave 4 low here, a 1, 2, 1, 2, 3, 4, 3, 4. And then this ending diagonal, which can always slap on another ABC. And that's what we're currently seeing. So ABC, ABC, 3, 4, 5. Okay, most of the time a ending diagonal targets the 161.8% extension. And in this case, that would be 62.43 plus. So that matches really well with what we're seeing here. 160, I have 61, 62.84, but we can go to 63.63, 64.91 as well. Okay, so we should maybe expand this target zone to be a little bit more honest. We want to stay honest. So this is now the upside target we're going to look for, contingent on holding above Thursday's low. All right, so we have very little risk, massive reward. Please keep that in mind. There's never no risk. There is always some risk, but this is your risk. The risk is now about 110 points, and the reward is 300 to 500 points. Wow, what a wonderful trade setup. Last but not least, the monthly chart. This is a monthly chart where we look at the potential for a cycle 3, 4 instead of a 1, 2. These are then alt wave counts. And then 3, 4, and 5. So it's still on track. And this one can point into the 7,000s. But for now, this still looks also quite well from a 3, 4, 5 perspective. Dow Jones, still 2 wave counts. Here is the ending diagonal where we just completed wave 4. Okay, after a wave 1. Wave 1 was like a zigzag. This is just, yeah, whatever you want to call it. Remember, yesterday's low did not go below the week before that low or 2 weeks before that low, whatever it is. And here are the warning levels for the bulls to tell us the bull market is over. We have to drop all the way below 37,500 essentially to suggest the bull market is over. Then this entire rally from April 2024 is over. And I would already get very concerned if we break below 4,000. Okay, and of course, the first warning level for the bulls is now at the initial low here. at about 43,000, I believe, or 42,500, 42,500. Okay, so these are the warning levels, and we can still see another 5 contingent on holding above these lows and akin to what I just showed you for the S&P 500. But please remember, it doesn't have to. Huh? We have seen a much severer drawdown for the Dow, which had a record amount of down days in a row earlier in December. I think it was since 1974, something like that, that we've seen so many down days in a row. And here also massive positive divergence. I like it. Okay. Alternative is that we've had indeed topped. It's all about how do you interpret this price action from pretty much March into August. Is this a ABC for a 4 and then a 3 and a 4 and then 1, 2, 3, 4, 5? You see the difference. Okay. How to interpret this? I don't know. Okay, I admit I don't know. I don't have all the answers. Nobody has all the answers. Okay, there's no computer program in the world. There's no quantum chip in the world. Good luck, Google, figuring out exactly what this is. It will probably come up with many possibilities, so many that you probably start spinning your head off your shoulders. So this is the best we can do. And this means higher to about 44,000. Okay, akin to higher to, of course, new all-time highs. Both are looking higher, contingent on holding above the January and December lows. Very simple, okay? Thursday's low holds, we're good. That's the two main primary wave counts with, of course, the warning levels for the bears on the bearish wave count and, of course, the warning levels for the bulls on the bullish wave count. But these are really big picture wave counts that really invalidate. This wave 4 can still move lower if it wants to, as long as it doesn't go below. Oh, I need to adjust, of course, the wave 2. If it goes really below the wave 2, all that's left then is this is potentially just a first wave, right? Then this entire advance was just a first wave of a leading diagonal. But of course, if we then drop it below the start of the first wave, it's not a first wave anymore. Very simple. And this is the bigger picture where we just look at annual candles and all down years are corrective years. And this has worked for 99% of all the waves we can count since the 1920s. Unbelievably accurate, okay? So this suggests we still need to see a 7, 8, 9, a down year and an up year, okay? Because it needs to be an impulse. If this is correct, it might not be, but this suggests we're not done yet either. So it supports, of course, the first case. Moving on to the IWM, I've had some questions about this. Still looks good here for this wave 4. We bottomed at the 61.8 over the last several days, right? This was earlier in the decline. As you can see, the IWM is a little bit off versus the other ones. And it's trying to recapture the first warning level again. So far, so good. I know it's a little messy chart with the Fibonacci ratios. I'm going to take the green one out because it reached 161.8% extension for green wave C. And I'm going to take these labels away as well. It's all C of C of C of 3. So far, so good. We have had quite a similar decline in depth for the potential wave 4, right? Versus, of course, the wave 2 here. So this should then do it. I'm going to take a few labels away so it's not as busy. That is then 1, 3. We've completed this very overlapping, which really is a hallmark of a diagonal. And now in this wave 4, okay. So we have, of course, here about similar trend lines. We can start to adjust it a little bit. That's okay. Right, it's almost identical in trend perspective. There, we're holding above the 200-day moving average. Again, we've reached the upper end of the ideal wave 4 target zone. Right, of course, this wave 4 can never go below the end of wave 2 and the start of wave 3. But this looks really good otherwise. I like it. This looks really still like trend channel serving. So as long as we hold above 217, I think we can start looking for 250. Okay, for this potential wave 3. Also here, the wave count is slightly different than some of the other indexes. That's fine. So the first warning level for the bears is here at about 225. And then I would say the second warning level would be probably here at about 230, right? That's that dreadful Fed day. And then the third warning level, let's move it to somewhere here. So about 237 based on these price levels, based on this close here as well. It's been kind of, and of course, the final warning level is here at the 244-ish. Okay. So far, so good. This looks still good. Also here, good positive divergence on the RSI 5, as you can see there. So that's also encouraging. And declining momentum, increasing money. As long as we hold above 217, this can move higher. I realized I don't have actually the NASDAQ and NASDAQ 100 on the chart. I jumped to conclusions here, so to say. Let's start here with the NASDAQ. And this is then the closing price basis. Look at that. Almost reached the ideal wave C of 4 target zone. Looks good to me, okay, of a completion. As long as we hold this week's low, we can target higher into the mid 20,000s for the NASDAQ, okay? This is an ABC so far. Remember, after 3 waves lower, always expect at least 3 waves back up, right? That is, of course, the premise, with the preferred wave count, the low being in place. Then let's go to the NASDAQ and see what we have, see if I can find the right chart. Also here, bottom right in the ideal wave 4 target zone. We didn't really reach the ideal C wave target zone, fell a little bit short, but we did reach the red. Okay, so this is good. And we don't have here positive divergence yet. So that's slightly negative on the NASDAQ 100, but we're back above the first and we're right knocking on at the second warning level for the bears. So question is then, is this wave C and is wave 4 complete? Well, I'll show you the possibilities and it might certainly be the case. Okay, so this is then kind of the trend line that we've been watching there. So can it still go lower? Yes, it can. But now, once again, the risk is here from 21,300 is 1,000 points, and the upside reward is 1,500 to 2,000 points. Okay, so that's a 1-to-5, 1-to-7 risk reward ratio. So the NASDAQ might not have bottomed just yet. And again, so here is our length of the A wave. And normally we get then the length of the C wave, but it doesn't have to be exactly. And as you can see, we got awfully close. This is the difference, right? 200 points. Now, what's 200 points, right? Is that a lot? Well, let's start having a look. Okay, instead of 2,600, we got 2,800. So divide that by 2,600. We're off by 0.97%, not even 1%. I think that matches really well with our general accuracy of forecasting the markets. So this is then our preferred wave. And remember, we've already forecasted this almost in November. Okay, this is what we were looking for, the completion of 3. Back in November, we were already looking for it. During the Trump rally, so to say, we were looking for it. That we either are going to complete wave 3 here, or we're going to get a protracted wave 3. We got a protracted wave 3. And then we would see a wave 4 and then a wave 5. So the overall pattern remains the same. I see no reason to change my tune. Since the August low, it still does not look like a complete impulse higher, or if you want to call it a motive wave, because a impulse is non-overlapping and a motive wave is like a ending diagonal or a leading diagonal. It can be overlapping, but we have not seen 5 waves up from the August low. And if you're in it for the long term, no, we've not topped. That is my honest opinion, unless we go pretty much below the September low. That's where we are at. So a quick review then of the short-term wave counts for the NASDAQ. Let's see if I can pull them up. So the first one is the A, the B, the C. So we're about to complete a wave A. I would like to see it go to about 21,390. Drop back here to about 2,100. Potential gap close here. Doesn't have to close the gap. And again, this looks quite impulsive. 1, 2, 1, 2, 3, 4, 3, 4, 5. Starts to look pretty impulsive. Again, all this positive divergence we pointed out already in earlier updates has finally materialized. So this is the first short-term option. And again, we cannot distinguish this from an impulse, right? This A1, B2, C3. And then we'll see if we get 4 and 5. The second option is we have indeed completed all of wave 4. And all we got was 7 waves lower. It's okay. It's a 3-3-3 type of correction. That's okay. Doesn't necessarily have to be a 3-3-5 or a 5-3-5. A 3-3-3 is fully acceptable as well. We broke above the first warning level for the bears on the hourly chart. The second one is at 21,500. The third one at 21,850. And the last one is, of course, at 22,140, I believe. So yes, this suggests wave 4 is complete, as we saw here. And then let's see if I can pull up to the last option where we see what I have here. The last option is pretty much, okay, this is a very protracted 8th bounce, right? 8th wave, and then we get the 9 to complete a impulse, so to say, in a overlapping fashion. So there would be some wicked diagonal. Don't see it, don't like it. It's just possible. So as long as we hold above, of course, Thursday's low, this is off the table. Okay. So this is the least preferable option. And let me pull up the other option here as well. As I showed you here. So that's the ABC option. And then this is similarly to the ABC, where we can't distinguish yet between the A wave and the first wave. So we're going to top here for wave 1 pretty soon. Don't have to. Okay. We can strongly rally out of the gates, but I would like to see this. And then, of course, the wave 3, right? And then you get a wave 4. And I'm going to put the fib extensions in it pretty soon. Give me one moment. And then, of course, we get the wave 5. And that would then complete 1 of red 5. And then we get green 2, green 3. Okay, so this is what we are currently looking at. So also here, we're probably going to see some sort of retrace Monday, Tuesday, Wednesday, some of those days, I guess, right, to the ideal retrace target zone somewhere around here. Doesn't have to be here, right? We'll see. Sometimes it's a 38.2, sometimes it's 23.6. Okay, so this is, of course, also possible. But let's just say, okay, we're going to retrace to right in the middle, about 2100. Okay, and if we do 2100, we're going to top out here at gap fill somewhere around here, 2100. Then you can see this would be 3, this should be 4, and then this should be 5. Okay, so matches quite nicely. And again, the 3 cannot be distinguished from the C. Right? It's the same. Depends all exactly where it's going to top, but we'll follow and track along. So also this one is looking for a pullback and then a rally. Pullback and then a rally. And the worst case is we're going to drop real hard out of the gates. But then we also know that we're getting very close to a tradable bottom. And this is where we're at. And yes, our wave count has changed since the initial 5 waves lower, where we were looking for a more protracted, longer wave 2, 3, 4, 5 of a standard impulse. But that's all we can go by, right? We do not know the future. So we simply start off with, okay, it's 5 waves lower, according to our count. Then we should see, 62% retrace. We didn't get it. It was only 38.2%. Just as I show you here, it can be very shallow, the retrace, just as the bounce can be very shallow in a bear market. You can have a bear market for a couple of days. It's all the time frame you're looking at. So the bear market on the hourly time frame, you can see it was a disappointing rally. The next rally was also disappointing. The next rally was also disappointing. I know they all lasted 2-3 hours. That's it. And now we have a rally that has lasted 1, 2, 3, 4, 5, 6 hours. So it seems to be a completely different nature and different type of wave. That's why we're presenting the 1-2s versus ABC, with the alternative, this being still part of the larger 4th wave, but most likely not. Also here, 3 down, 3 up, and then 3 down once again. I have a very hard time counting this as a impulse. Could be, it's fine. Might be 9 waves lower if you can count it that way. Good enough for me as well. But we've done technically enough. That's really the bottom line. And you can see how the 1, 2, 3, 4 is initially indistinguishable from an ABC. Okay, so we're going to track both. Alternative is, we're going to see one more lower low. But that's really the alternative. That is our lower odds forecast. So, and then of course we, with the current assessment, we have to make a judgment call on where do we think this wave 2 is going to bottom. Just as we made a judgment call in late December that we would see an impulse lower. Again, that was what you start off with. You anticipate, you monitor, you adjust. That's all you can do. We cannot predict the future. I do not know what's going to happen on Wednesday. I do not know. Nobody knows what's going to happen on Wednesday. Nobody knows. Okay, that's the whole nature. So we start off with the standard Fibonacci-based impulse pattern. And sometimes you get it completely right, just as we did here for the bounce, right? And then sometimes you get it wrong. There is no standard impulse pattern. The market decides to do something else. But we're always quick to turn around and then say, something else is going on. What is it? As soon as you recognize it, that's the beauty of it. You'll get on the right track again. And that's why you get 70% reliability. All right. So we've covered the NASDAQ 100 in great detail, IWM as well. Oh boy, this is a long story. The least favorite index of all is for me the semiconductors. It's a mess. We can still be in this protracted B/2 wave. I have the least confidence on this one. I haven't even updated the wave count. It's an utter mess. I don't really know how to count stuff on this. So sorry about that. I need more price data to know what's going on. The rally since November looks weird. I don't know what to make of it. So that's it. Speechless, without words. Moving on to more important things. So semiconductors, I can't say anything about it. If you prefer to trade those, I don't have a good answer for you. I'm sorry, but I think you have to be very strong to say, I don't know. I would like to have more data and I'll get back to you. That's just the way it is. Sorry, sometimes we just don't know. So then let it be. There's plenty of other indexes out there to trade. Don't get married to one. Anyways, NYAD, the advanced declining issues for the NYSE, okay? Wonderful. Look at this. Strong positive divergence. This is what you like to see. This is really good. Okay. So now also we see a breakout or try breaking out above this downtrend line. So we had negative divergence here between late November and early December, which has ushered in the current correction. Now we have positive divergence between the December low and pretty much, also again, I think the December low or January low, whatever it is, this secondary low. Very good. This is a very good signal. How we're doing on the McClellan oscillator. Massive positive divergence. So we have our initial low, as you can see. We have our initial low, right? The initial low here. And then with increasing market breadth. But you have our secondary low right there. So with increasing market breadth, that's positive divergence. That's often a very good sign. Okay, it's not the can all do all, but it is additional weight of the evidence that we've declined while more stocks are starting to increase already. I could give you a handful, honestly, that look really good. One of them is NVIDIA. So looking here at the summation index, which is the McClellan oscillator from yesterday, added to that of the day before yesterday, etc., minus 390. So we're getting quite oversold. Why? Because, of course, the summation index is still negative. Once it turns positive, this one will also turn up. And as you can see here, over the last 3 years, 22, 23, 24, I can go back further in time, but it's just to show you the idea that if we get below minus 500 or close to it, we're getting often very close to very tradable rips, if not long-term bottoms. Long-term bottoms tend to happen between minus 500 and minus 1,000. Go below minus 1,000, wow. And of course, very oversold on the RSI 14, which means that soon there is room for plenty of upside left. So also this one supports soon higher prices. Okay, so we had this negative divergence, but as you can see, negative divergence takes a long time before it kicks in. But positive divergence is something entirely different. How we're doing on the buy all sell all indicator. No buy signal yet, but I want to compare the current setup with that of April, May, and a little bit of January of last year. You see here how long it was flatlined, and what a rip we got out of it. This was a 3-month rally, okay? So this could very well happen and really indicate that this fifth wave is going to start as anticipated. I have no buy signal yet on the KST to support it, But you can see also here November, even though the signal was not as pronounced, no flatlining really, we got very good rallies out of it. So this is ideal setup for higher prices. If Monday or Tuesday or Wednesday are going higher, most likely we get a buy signal. Not there yet. How about new lows? All right, they've dropped significantly, okay, from very high triple digits to now double digits, below 50 soon for the NYC, below 50 for the NASDAQ already. Good sign, okay? So you can see here as well, we have divergence in new lows between the initial low and the secondary low. Initial low, secondary low. So more stocks are advancing. That's a very good sign. Bottom line, very good sign. A bullish percent index for the S&P 500 bottomed below 40. Okay, those are pretty low levels. The last time we went this low was again in October of 2023. Okay, so this is a tremendous low reading. Very good. Looks pretty washed out. Also here you can see how long it takes before negative divergence kicks in, but this is a very good sign. I like it. Long-term indicator. So we're looking at stocks only new highs versus minus stocks only new lows. And we got a buy signal on this one, a buy crossover or a positive crossover. Okay, so we had a negative crossover in December, early December, it went down. Okay, and now we're getting back up because the cumulative one is at 38,172 and the SAR, the SAR reading, is at 38,185. Oh, well, how does that compare to previous instances? September, same deal. We went here from a low, so a reading that was below the SAR to above the SAR. Same here in August. The August decline, all right, went below it, back above it. Slight fail here in June. Nothing works all the time. 60% of the time, it works every time. Last but not least, April of last year. Also here, we went from below it to above it, okay? Below it, above it. So you can see this is also a very good sign. All of these support the case that the low is in place. Price is the final arbiter. As long as we hold Thursday's low, this is the case. How we're doing on sentiment? Yeah, pretty washed out for active money managers, 64%. So we went from pretty overexposed to now underexposed. The long-term average is 72% exposure to the market, okay? This is tens of years of data, if not longer, like 20, 30 years of data. So you can see these very overexposures are not ever really aligned with significant market tops, maybe once or twice. So they don't mean much. Underexposure is much better. How we're doing on the fear greed indicator? I think we were 26. Yes, we were 26 on Thursday, which is close to extreme fear. Very close to extreme fear. Very nice. I like it. AAII, well, of course, you know, we had the holidays in between, but a little bit below the long-term average on bullishness, above the long-term average for bearishness. And that is also a good sign that we're getting close to a bottom. Nothing significant. I would like to see, of course, bearishness much higher, but this also is pretty significantly skewed towards a bullish resolution. So that's all I have for today. Thank you for watching. Thank you for listening. Thank you for being a valued premium member. Again, if you're watching this on YouTube, you're a dollar short and probably 3-4 days late. But that's that's what you get when you look at free stuff. You get what you pay for. Sorry to rub it in one more time, but I think you always get much better if you pay for stuff. And make sure you pay for value, okay? Quality over quantity. And we provide quality. Take care, trade safe, catch you all next week.